Now, our next guest, not exactly cheering for the U.S. debt solution that was reached over the weekend. His view is simply that macro issues may go to the back burner. Investors need to be more focused on corporate earnings. Joining us to dig a little bit further is David Burrows. He's president of Barometer Capital Management. David, great to see you this morning. Let's talk about, first of all, your thoughts on the debt ceiling. You know, you had a bit of time to take a look at the deal. Is it a solution in any way? Can we call it a solution?
Well, I don't think that you can call it a solution, but you can say that some of the uncertainty that we've been facing over the last couple of weeks has been moved off further into the distance, and certainly there is an improvement. This market is fighting with a lot of uncertainties, and you can see it in the way that investors have been moving towards things that offer them what they perceive will give them some certainty, like some of the sovereign bonds. But that being said, you know, it appears that as we go through this summer, we'll get some more clarity on some of these issues. We are part of the way through this U.S. debt problem. We'll get a little further down the road today with a vote, and then, of course, we're going to see what happens over the next few months. But certainly the market is struggling with a lot of sort of macro uncertainties right now.
And what is that going to mean then for the equity market? When you look particularly at the U.S. market, the package that we see now and what it could do for the U.S. economy, which sectors are going to be affected? Which ones are going to be hurt, I guess, is the most important question.
Well, you know, it's a very good question, and it's an interesting one, because whereas in the corrections we've seen sort of through the course of the spring, where there was very high correlation in almost every industry getting impacted, this market, the correlations do seem to be coming down, and certain industries are haves and certain industries are have-nots. On the have-not side, certainly, you know, defense and healthcare are on the defense and are being impacted. You know, we know that the ongoing regulatory environment's made it difficult for financial services. And then probably industries that benefit from government spending, like engineering and infrastructure, are likely to have some difficulty as well, and are in their share prices. On the other hand, there are some industries that appear to be doing marginally much better.
Okay, so where are you putting the clients' money to work right now? Is there a sector that's standing out in terms of opportunity for you?
Well, I think in the face of you know, weakness in concerns around debt, and then also weakness in global economy, there are certain themes that do stand out. Certainly, investors are looking for more certainty rather than less, and so they're looking for, first of all, and probably the most important theme, is yield. And specifically, I think they're looking for yield in the form of corporate securities that have stronger balance sheets and have had a history of sustainable dividends and, of course, growing dividends. So things like real estate investment trusts, things like some of the telecom stocks, companies that have some pricing power and sustainability in that dividend. That is one particular area.
Do the financials fall into that category?
I really think that the financials are fighting an uphill battle here. Certainly, you know, the Canadian banks are in better shape than the global banks, but globally, you know, the big systemic risk still is in financial services and their exposure to sovereign debt. And then, of course, they're all facing a very difficult regulatory environment, almost a hostile regulatory environment. So if you're looking for dividend growth, I think that investors in general will be disappointed by the growth rates and dividends going forward as compared to what they got used to over the last 10 years.
All right, let's dig into the market in particular. And we've spoken about energy in the past, some of the ways you're playing it. I think you're taking another look at Halliburton. You like what you see?
Yeah, we like the services companies, we like the producers, and we like the midstream asset companies. Halliburton in the services side has a real strong focus in some of the North American onshore services work. It is a global company, however, but this is a company that gives you good broad access to all of the drilling that's getting done in using some of these new technologies.
And we were just looking at the chart, and it's a pretty strong-looking chart. I mean, do you like the valuations at these levels, even, you know, especially given that performance?
I do. I think that as an investor, you always have to focus on the leading themes, and it is interesting that we are at the low end of the trading range for the major markets. And there are certain themes that are trading very close to new highs, and the drilling companies and the services companies are one group. And you could look at in the U.S. a Baker Hughes, you could look at a National Oil Well, which makes equipment. This whole industry has a real tailwind, because certainly globally the developing consumer is sucking up a lot more energy.
You were mentioning good dividend payouts and stability there. What about RioCan REIT? Where does it fit?
Well, the REITs are probably our biggest holding as a firm at Barometer. And it's because not only can you get sort of 5.5% yields, but they're growing every year by 4 or 5%. RioCan has great exposure to, of course, shopping malls across the country, big box retailing centers. They have very strong tenants. They have very high occupancy, and as a result, have pricing power. And so, Canadian real estate really didn't get overbuilt the way that the U.S. real estate did. These REITs have a low cost of capital. They can borrow money inexpensively right now because they are fairly predictable, and they can build projects to yield them, accretive earnings.
I was talking with Barry Knapp from Barclays Capital earlier. They really like technology right now. They've recently upgraded. What do you think about technology? Is there a name there when you look, I guess, at the U.S. that stands out for you?
Sure. Well, technology would be one of the 4 key themes, and you have to be very specific. And we're looking at companies that help companies get productivity. We may not need more capacity out of a lot of the corporations, but we need productivity to help grow earnings. And so you can look at some of the broad themes. IBM would be a great example, and it's been a holding of ours for quite some time now, because their services business gives them a very predictable revenue stream to global and exposure to global corporations who in general are doing pretty well. But their software business, which helps corporations mine the data that they generate within the organization, is really in demand. So very strong visibility in earnings over the next 3-4 years in what would otherwise be a pretty uncertain economic environment.
All right, David, great to hear from you this morning. Thanks for your time.
Thanks for having me this morning.
That's David Burrows, President, Barometer Capital Management.